In this video, I want to highlight the relationship between interest rates and currency value. The relationship between the interest rates, the prevailing interest rates, and the value of a country's currency. An interest rate plays a crucial role in determining the value of a currency in the foreign exchange market. The relationship between interest rate and currency value is driven by movement of capital, investor preferences, and the overall economic conditions. So here is how interest rates impact currency values. So these are what we are going to look at. These are factors that will then serve as a pointer to how interest rates affect currency value. Number one is high interest rates attracts foreign capital. The higher the interest rate, the more attractive it is for foreign capital, foreign investors to come and invest in the country. When the country raises its interest rate, it offers higher return on investment denominated in its currency. As a result, foreign investors are more likely to invest in the country's assets, such as bonds, stocks, banknotes, and to also take advantage of higher yield. They do all these things to take advantage of the higher yield that comes as a result of increased interest rates. And so this influx of capital increases the demand for the country's currency, causing it to appreciate, in value during, in value relative to other currencies. Number two is lower interest rates weaken the currency. Lower interest rates weaken the currency. Just like higher interest rate attracts foreign investors and boosts the value of the currency. So in an environment where there's a weakened interest rate, it will certainly lower, in an environment of lower interest rate, it will certainly lower the value of the country's currency. So conversely, when a country lowers its interest rates, it typically reduces the returns on investments in the country's assets. This makes the currency less attractive to foreign investors, leading to a decrease in the demand of the currency. As a result, the currency tends to depreciate, relative to others as investors seek better returns elsewhere. That's the way it works. It's purely a function of demand and supply. The more investors demand for the country's currency, it will rise. The least the demand for it, and of course, the currency will certainly weaken. Number three is interest rate differentials. Interest rates are differential. The difference in interest rates between two countries, known as the interest rate differentials, is a key factor in currency value. As if one's country's interest rate is significantly higher than those of another country, the higher yielding country is likely to appreciate as capital flow into the country with the higher rates. So investors actively monitor these differentials to make decisions on which currencies to buy or sell. It depends purely on the demand and supply of the given currency. Number four is monetary policy and central bank actions. Monetary policy and central bank actions. Central banks, influence interest rates through monetary policies. They have monetary policies, they have monetary policies, and which they use most of the times to regulate the economy. For instance, when the central bank raises an interest rate to combat inflation and stimulate economic growth, the currency typically appreciates due to increased interest rates. On the other hand, when a central bank cuts rates to boost economic activity during a slowdown, the currency may depreciate as it becomes less attractive to investors. It's a matter of how attractive the currency is. The more attractive it is, the more value it will gain. The less attractive it is, the lesser the value it will attract in the market. Please like this video and subscribe to this channel if you've not done that. Number 5 is expectation of future interest rate. Expectations of future interest rate. Market expectations about future interest rates changes also. There's this particular interest rate fluctuation, interest rate variation, interest rate changes. It tends to play a role in the country's currency values. And so if investors anticipate that a country will raise interest rate in the future, they may begin to buy the currency. They may act proactively and buy the currency in advance with the expectation that when the government eventually raise interest rate, the currency will appreciate in value. So that is what investors do proactively. And not only that, number 6 is impact on inflation and economic condition. Impact on inflation and economic condition. And so interest rates are closely tied to inflation control. So higher interest rates generally reduce inflation, which can strengthen the currency by preserving purchasing power. So on the other hand, lower interest rates may fuel inflation, leading to currency depreciation as the real value of the currency erodes. Then number 7, currency speculation. Currency speculation. Interest rate changes can also attract currency speculators. Traders in the Forex markets anticipate shifts in interest rates and trade currencies based on the expected move. So each time they expect that there will be a shift, a rise in interest rate, they will trade accordingly. So speculative activity can drive large and short-term fluctuation in currency value, especially when market expectations are not met. And in conclusion, interest rates directly influence currency. It influences currency values, as you all know, by affecting the returns on investments and capital flows. So higher interest rate tends to appreciate a currency as they attract foreign capital, while lower rates can lead to depreciation. It's just an inverse relationship, just like the opposite side of the coin. Also, the relationship between interest rate and currency values is influenced by both central bank actions and market expectations, making it a critical factor for Forex traders and investors to monitor when assessing currency movement. So you have to monitor interest rates, central bank action, actions and other related moves, so as to be able to determine the approach you are going to adopt in your forex trading.